All right, if you're in the crypto space, you know there's this one question that always comes up. And let's be real, it can be a total headache. So let's just dive right in and clear up some of that confusion, shall we?
Yeah, this is the big one, right? Do you actually pay taxes on Bitcoin? You've got in, maybe you've seen some nice gains, and then that little voice in the back of your head starts whispering, uh-oh, what about taxes?
So, if you are hoping for a simple yes or no, well, I've got to break it to you. It's not that easy. The real answer is a little more complicated because it all boils down to what you actually do with your crypto.
Okay, let's start at the very beginning, the simple act of buying. What happens, tax-wise, the second you make that first purchase?
And here's the first piece of good news for you. In most places, just buying and holding your crypto, what we all call hodling, is not a taxable event. Phew. As long as you don't sell it or trade it, you haven't technically made a profit or a loss. So for now, there's nothing to report.
But of course, hodling is just part of the game. Sooner or later, you might do something else. So let's get into it. When does a tax bill actually appear? What are the actions that do wake up the tax man?
The key phrase you've got to know here is taxable event. Just think of it like a tripwire. It's any move you make that suddenly creates a tax consequence.
And this really lays it all out, nice and simple. On one side, you've got what's not taxable. Just buying and holding. You're good. But then look at the other side. This is where things get interesting. Selling for a profit? That's the obvious one. But that second point, swapping for another crypto, man, that's the one that catches so many people off guard.
Okay, let's really break this down because this is super important. When you swap, say, your Bitcoin for some Ethereum, you might think you're just trading one digital coin for another. But that's not how the tax authorities see it. In their eyes, you just did two things. You effectively sold your Bitcoin at its current market price, and then you immediately used that cash to buy Ethereum. So if your Bitcoin had gone up in value since you bought it, boom, you just created a taxable gain on that sale part. It's a huge thing to remember.
All right, so we've covered buying, selling, and that tricky business of swapping. But what about when you're not just trading crypto? What if you're actually earning it?
Yeah, I'm talking about things like staking rewards, mining rewards, or even getting some airdrop tokens. All of those, they're usually treated just like regular income. That means you're probably going to be taxed on the fair market value of that crypto at the very moment it hits your wallet.
So now we know what can trigger a tax event. But here's another layer of complexity. The rules themselves can always change. They are absolutely not set in stone and can be wildly different depending on where you live and even how long you hold your assets.
How long you hold your crypto can make a massive difference. A lot of countries have different rules for short-term gains, like if you hold for less than a year versus long-term gains. And usually, they tax those long-term holds at a way lower rate, to encourage people to invest. Some places even have rules where if you hold on long enough, your gains could be completely tax-free. How cool is that?
And this really hammers the point home. Look, crypto tax law is basically a global patchwork quilt. You've got countries like Germany creating favorable laws, and then you have others who are way more strict. The point is, everyone's rules are different. That slice on the chart that says your country's rules, well, that's the only one that really matters for you. It's a huge reminder that you absolutely have to do your own homework and figure out the local regulations.
Okay, I know. With all these different rules and variables, it's easy to feel overwhelmed. But it honestly all comes down to one simple golden rule. And trust me, this one rule will save you a world of pain later on.
And that rule is track everything. I'm serious, you've got to be meticulous. Track the price and date you buy. Track the price and date you sell. Record all the fees, because you can often deduct those. Keep a record of your wallet addresses. This right here, this level of detail is going to be your absolute best friend when tax season rolls around.
Look, if you only remember one thing from this whole explainer, please let it be this. Always check your local laws, or better yet, talk to an expert. Tax laws are complicated, and they're always changing. Finding a tax pro who actually gets the crypto space isn't just a good idea, it's probably one of the smartest investments you can make.
So I'll just leave you with this final question to think about. A great crypto strategy isn't just about picking winners and selling at the right time. It's also about being ready for the tax side of things. So ask yourself, is your crypto strategy really ready for tax season?